Hi, my name is Jeff Schneider, and I'm an enrolled agent and a certified tax resolution specialist and an author of a new book called Help! I Got a Tax Notice from the IRS, Now What? Well, today I'm going to talk to you about some problems that have come up during this tax season about required minimum distributions and the same thing about charitable donations. If you're over 70 and a half, you're required to take monies out of your IRAs. We're not talking about Roths. There is no requirement for that. But if you have an IRA, 401k, you have to take monies out of it. And those monies are based on the value of all your IRAs. You may have 5 or 6 in different banks, different financial institutions, but you have to take it based on the value in all of them. You can take some out of each one, or just 1 or 2 or 3 or whatever, it doesn't matter. But as long as the dollar amount is correct. And how is that figured? It's based on the value and some actuarial tables and mortality rates. And usually your financial advisor can do that for you. There's also many websites that allow you to do that. So remember, when you're 70 and a half, and it's usually by the 6-month birthday of your 70 and a half, so almost when you're 71, and you can double up in the first year if you turn 70 and a half in the next year. But you have to take out a certain amount of money. Just be aware of that. If you're not, the penalties can be pretty stiff, 50% of what you should have taken out. So make sure that your financial broker knows that when you're turning 70 and a half, that he calculates it for you. The second thing I want to talk about is when you're also 70 and a half and you are taking out these required minimum distributions. So it's a caveat for both. You're 70 and a half and you're required to take the money out. Again, Roths you don't, so it doesn't qualify. Now, most of my clients that are in that age bracket do not itemize. They already paid off their house. They don't have big tax bills, so they don't itemize. They take their standard deduction. They take their extra standard deduction because they're over 65. And they go on their merry way, but they want to make a contribution to charities. Now, you should make a contribution to charity because it is the charitable thing to do, but you also get a tax break if you itemize your tax, your deductions, mortgage, interest, real estate taxes, and charitable. But what happens if you don't itemize? Well, there is an exception for those who are 70 and a half and make under $100,000. You can have the broker pay directly out of your IRA and transfer the money directly to the charity. Not to you, then to the charity, but directly to the charity. It's not taxable income to you like the normal distribution would be, and you also don't have to worry about a tax deduction. So it's basically a wash. There's no effect on anything, but at least you'll be able to get a benefit to the charity without having to pay tax on that money, and you satisfied your required distribution. So contact your tax advisor for specifics about that. There are specific rules. Or contact somebody like me, an enrolled agent who knows those rules. So until next time, see ya.